All right, Bruce. So credit scores. This one's super interesting to me. And actually, early in our life, Renee and I we didn't really have we didn't have really any credit established, right? And that was a negative to the credit bureaus. They were mad, even though we paid all our bills, we did all our different stuff. The fact that we didn't have open credit lines was actually a negative to us. So can you kind of talk about when you have a high credit rating, what went into that, when you have a low credit rating, and how both high, medium, and low credit impact your ability to get a mortgage from a interest rate, cost, the whole deal? Can you go through that?
Yeah, absolutely. So there's a couple different things that you kind of break it out when you're talking about credit, right? One is the score that you asked about,
right.
And scores typically range. You'll have typically 3 FICO scores, one from each of the main bureaus, and these can vary considerably from one to the next. That could be something gets reported to one and not the other. There's several things that go into it and how it looks at it. Now, score-wise, the higher the credit score, typically the more products and programs you're going to have available to you, and the better pricing that you're going to get within those products and programs. Though there are products that will allow for a lower range credit score, maybe something below 580 or something between 580 and 620, you're typically going to pay a premium for those products to be able to get financing. The credit really does matter a lot. Typically the range of credit, when people talk range or tiers or buckets, they go in 20-point increments, right? So 600 to 619 would be a bucket, and then 620 to 639. So every time you can get higher in one of those buckets in credit score, your pricing relative to the product and program that you're in are going to improve. Guidelines also change based on credit score tiers and buckets, not just pricing. So you might need more requirements and documents to get into one of those homes in a lower credit score range than you would possibly need at one of the higher credit score ranges. So that's one big part of it, is the credit score. And though, like I said, there's products and programs available based on the different credit tiers, the pricing is also heavily impacted. A client that's a 740 plus credit score could see considerably lower pricing on the same product for someone that's at a 698 credit score. So it's not just the score, it's the buckets and the program relative to credit. And then the other factor that I mentioned was the line items, like you said, derogatory items, crush credit.
Touch on yesterday. You said you had one that credit score could qualify, right? We were talking about this yesterday. But when you looked into the reasons their credit score was what it was, they weren't financeable. Can you touch on that real quick?
Absolutely. So when you look at credit and you look at derogatory items, whether it be collections, whether it be charge-offs, those items that got charged off or obviously were collected upon play a role. For this client, it was I don't know if it was a rent payment or an eviction, but it was something to do with housing.
Right.
So when we're talking about doing a mortgage loan, which is a loan to get a house,
which is housing.
Housing matters in your history of payments and housing history. So when you talk about those items, not only do collections play a role, not only do charge-offs play a role, open line items, like credit cards that you have, if you get them to zero, doesn't mean you should close them, because having the history of a line open helps your credit.
Right.
On-time payments helps your credit, right? So those are positives. The one thing that's a quick fix, and we do this at time to analyze clients that are on the cusp, are credit card balances. Proportion the balance to limits can really heavily impact your credit score. The good news, those are just an instantaneous impact. The minute we pay those down, call it to a 60% utilization. So for a $10,000 card, you get below a $6,000 borrowing capacity at that time, you could see your score go up 10, 20, 50, 60 points, depending on the bureau and depending on how that impacts it. So credit is hugely important when you talk about financing, not just from a general qualifying perspective, but the pricing. And when I say pricing, that directly impacts the payment to the mortgage that you're going to take out.
Yeah. And we spent a fair amount of time talking about the negative, or not the negative, but the lower stuff. But at the higher stuff, you can get stuff like an appraisal waiver, right? You can get a lot of things, and you said this, you touched on it. They're going to require a lot more docs at lower credit scores than they do at the high credit scores. And that only makes sense, right? Because it's a risk profile. The riskier the file, the more documentation. That's the best way to think about it. So if you have any questions about your credit, what your actual credit score is, not Credit Karma, not credit whatever that they come out with now, but actually from the 3 bureaus, go ahead and reach out. We'd love to chat with you about your situation. And if you like this content, like the video and go ahead and subscribe to our channel. Thank you.